Hey guys, JC Parets here, founder of AllStarCharts.com, and welcome back to the JC Show here. Nice little collaboration between StockCharts TV and All Star Charts. So what we like to do once a month is sort of take a step back, talk about the most important trends and any opportunities that we might be finding out there. You know, the way I like to look at it is, you know, what's got my attention? What am I looking at right now that I think is super, super important? And I got to tell you, it really starts with the US dollar. We got a 3% decline in the dollar coming into this week, right? So seeing a little bit of strength over the last couple of days in the dollar, a little bit, but definitely some weakness over a couple of weeks. A 3% correction, just 3% in the US dollar index. And look what happens. You get almost a double-digit move in mid caps, transports up 9%, small caps up 8%, NASDAQ up 8%. You know, growth outperforming, you know, expansion in stocks making new highs, which we'll look at here. Yes, the percentage of S&P 500 stocks making new 20-day highs broke that 55% level, which triggers a breath thrust of sorts. This is a lot of work done by Ned Davis and Jeff DeGraff, two technicians in my book. They're in the Hall of Fame. You know, they're two of the best in the business. If they're telling me 55% of stocks making new 20-day highs is the level we should be looking for, I'm going to listen. But just so you know, for me, it's less about, oh, is it 55% or 50%, 20-day highs, 30-day highs, 10-day highs. It's less about like those specifics, like kudos to Ned Davis and Jeff DeGraff, who've gone back, done the work. And I appreciate that most definitely. For me, it's less about all that stuff and more about, are we getting a bunch of breath thrusts or are we not? You know what I'm saying? Are we getting like, you know, rates of change in specific sectors or among components of a specific sector that we haven't seen in some time, that we haven't seen since the beginning of the last bull market and stuff like that. So it's less about, did it break 54%, 55%, 20-day, 21-day highs? Like, it's less about those details specifically and more about, are we getting a bunch of breath thrusts or are we not? And I wouldn't say we're getting a bunch of breath thrusts, but we're getting some, right? It's better than none, which is what we were getting before. Now, with that being said, still a bear market, still on a downtrend. We're going on 36 consecutive weeks where there are more stocks making new lows than making new highs. Bull markets, you see the opposite of that. Now, we're focused here on 52-week highs, 36 consecutive weeks of more stocks making new lows than new highs. However, on a short-term basis, which is what we're seeing here, but however, on a short-term basis, we are getting expansion in new highs. Let's remember something. These stocks are not just going to show up on the new 52-week highs list overnight. They're nowhere near new 52-week highs. It's going to be a process. You're going to see the 20-day high list expanding, 63-day high list expanding, 120-day high list, right? It's going to be a process, and then ultimately you're going to see it on the 52-week high list. But let's remember that we could already be in a bull market, right? The bear market might already be over. You don't know until after the fact. And the information that we're seeing is exactly the type of information that we should be seeing if we are in a new bull market. But if, in fact, that is what's going on and we are in a new bull market, you're likely to see more breath thrusts, more breath expansion, right? More stocks making new highs. That's still to be seen. What we've seen so far is characteristic of the beginning of new bull markets, most definitely. Extremes in sentiment and pessimism, right? Just washout levels. You know, crypto had its Lehman moment, Luna gone, Three Arrows Capital gone, what was it, Celsius, right? All of those things, just a lot of blow-ups. Those tend to happen in bear markets. We got those things. So, okay. So we've got the setup. Stocks can potentially go higher. What's the catalyst? Well, for one, I think the S&P 500 getting above 4150, 4200 is a big one. Below that, we're below all this broken support. This is the neckline from this massive distribution pattern. Call it a rounding top, call it a head and shoulders top. You can call it anything you want. The bottom line is it's characteristics of distribution. And that completed earlier this year. And now we're back to the scene of the crime. We're above 4,200 in the S&P 500. You can't be short. You cannot be short if the S&P 500 is above 4,200. I really think a weaker dollar is what's going to be the catalyst. I could be wrong. I've been wrong before. I promise you, I guarantee you, I will be wrong again in the future. Most definitely. If the dollar weakens, I can't think of anything more bullish. And the reason I say that is because the dollar has been the only safe haven. Here we're looking at the US dollar relative to emerging market currencies. Over the last year, as stocks have fallen, this year in particular, the dollar's been the only safe haven, not US Treasury bonds. Bonds got killed. Not Japanese yen, which traditionally has been a great safe haven. None of those things. The only safe haven has been the dollar. You can see here this rally here in the dollar. So we're back to where the dollar started to sell off over the last half decade or so. 2016, remember what happened when the dollar sold off? Stocks ripped. After COVID, 2020, remember when the dollar sold off? How'd stocks do? Ripped. What about now? See that? So here we're looking at the emerging market currencies as the numerator, the S&P 500 up on top. What happened both of those times that emerging market currencies bottomed? There were great buying opportunities for stocks. And here we are once again. Now, from a seasonality perspective, this is where you buy. This is where you buy from a seasonal perspective. This is the composite that we create. On the left, we've got last year. On the right, we've got this year. So last year was a post-election year. So we take all the post-election years since 1950. We take every year since 1950. And then we take every first year of every decade for the decennial cycle, and that creates that composite. As you can see here, the red line was the reality. The blue line is the composite, seasonal composite. Tracked tick for tick last year. Tick for tick last year. Weakness this year came ahead, right? So now this year is every year, every second year of every decade, every midterm election year, and every year since 1950. This is where you buy it. You buy the S&P in the summer of the midterm year. Right? That's where you buy it. Now, just because that's the case doesn't mean we're going to blindly buy stocks. No, of course not. This is to describe the environment. Sentiment, breadth, seasonality, all of that describes where we are in the context of things. And then we need to identify what's the catalyst to move things in the direction of, in this case, higher prices. As seasonal trends suggest, we should get strength into the midterm elections and through the end of the year. I can't imagine we're going to see any strength at all unless the S&P 500 is above 4,200. Unless the dollar is falling. So those are the catalysts. This is the setup. Those are the catalysts, right? We're not just buying everything because sentiment. Let me get to sentiment for a second. We're not just going to blindly buy everything because sentiment is at the worst level since the great financial crisis. We're not just going to buy it. What this data suggests is the rubber band is stretched, right? The rubber band is stretched. That's the environment. What's the catalyst? S&P above 42, weaker dollar. By the way, if you're interested in these slides, you can email info@allstarcharts.com and make sure to use the password breadth expansion. Use the password. They give a lot of presentations around the world. You don't want to get some Malaysian palm oil futures presentation. If you want this one, use the password breadth expansion. Breadth expansion. Info@allstarcharts.com if you're interested in the slides. Because we've been in a bear market for some time, my friends. This is not anything new. The average drawdown of the New York Stock Exchange is down 38%. 38%. This is the New York Stock Exchange. These are the best companies ever. Literally the best companies ever. The average drawdown 38%. In the NASDAQ, 43%, folks. 43%. We've been in a bear market for 18 months. This week, early next week, I suppose, technically, if you really want to, early next week, will be the 18-month anniversary of this bear market. February of last year. That's when biotech peaked, ARK funds, Chinese internet, everyone had a SPAC, the IPO index, NASDAQ advanced decline line, NASDAQ new highs list, all that peaked last February. It's been a slow deterioration ever since, right? To the point where the average NASDAQ stock is down 43%. 43%. All right. Here we're looking at the Dow Jones Industrial Average bouncing off those pre-COVID highs. but any strength is going to run into that overhead supply. So this is still a mean reversion rally, a heck of a mean reversion. And for you bear market aficionados, you guys know that the biggest and best and strongest rallies ever come in bear markets. The question is, are they bear market rallies or the beginning of new bull markets? In either of those cases, historically, they tend to be incredibly violent, incredibly vicious, very strong. And this time is no different. Dow Jones Transports, same thing, bouncing off that key Fibonacci level, but still below that overhead supply. Still have work to do. So maybe this is a new bull market. Maybe this is a new bull market. Maybe the bear market's over. But we don't have enough data to suggest that that's the case. This has been a mean reversion rally. That was our intention all along. Just because it's working out in our favor doesn't mean it's a new bull market. We still need to see it. Transports holding above 16, that would be impressive. Dow Industrials holding above 35, again, impressive. We're nowhere near those levels. In the meantime, this is just a mean reversion. And Bitcoin, same thing, right? Bounce off those former key resistance levels from 2018, former resistance turning into support. But just because that this is the case doesn't mean that we're not below all of that broken support. There's trouble with 30 for Bitcoin. So the Dow Jones Industrial Average, Dow Transports, Bitcoin, this bounce is real. Working out great. But we don't have enough evidence to suggest that it's anything more than just that. And we'll have to reevaluate when we get that data. We've gotten the data that precurses the data that confirms that. We've gotten, right, those pre-qualifiers, the prerequisites. We're getting some breadth expansion. We're getting some breadth thrust for sure. Need to see more to suggest that this is anything more than a mean reversion. In the meantime, it's a mean reversion. And who cares about what we're going to do in the fall or next year? We'll worry about the fall and next year, in the fall and next year, right? Let's worry about what we're doing now. And the mean reversion is still in play. Global 100 seeing the exact same thing. Russell 2000 bouncing off that former resistance, folks. Let's zoom in here on the small caps. Here's your fall 2018 highs. Here's your pre-COVID highs. All that resistance turned into support. Small caps, guys. This is one of the most important charts in the entire world. Small cap stocks. New York Stock Exchange also bouncing off that former resistance pre-COVID. High beta versus low volatility. Finding support at former resistance levels from the last decade. Value line geometric index. This is your median stock. Did nothing for 2 decades. Finally broke out last year, and we retested that successfully. And this one, friends, I got to tell you, this one really ruffles my feathers. This one, I don't get it. This is the financials index. U.S. financial sector, arguably the most important sector in the world, financials. You could argue. It's definitely in top 3, industrials, tech, financials, in my opinion. But you can argue, you can make the argument for each one of those that it's the most important one. Financials included. We don't have bull markets in America without financials. Fine. What just happened? We retested the highs from right before the great financial crisis. And nobody cares. Nobody cares. These are the highs in 2007. I think it was May 31st, 2007. These were the highs. We kissed those highs in 2018, failed again, got back to those highs right before COVID, failed again, finally broke out last year, a historic breakout in financials after 14 years of nothing. Since the great financial crisis, we finally broke out last year. And what happened last month? We went back to those highs. The highs in financials before the great financial crisis is by definition one of the most important resistance levels in the history of the United States stock market. It's literally called the Great Financial Crisis. So the peak before the Great Financial Crisis is like epic resistance. We were back there last month. We were at that moment. When we were there, Lehman Brothers still existed. Bear Stearns, AIG, Merrill Lynch, Wachovia, the one with the guy with the tan. What's the guy with the really bad tan? Countrywide. All of those things still existed. And we were back there. And nobody cares. Nobody cares. I care. I care a lot. Because that's one of the most important resistance levels on the planet. In the history of the stock market, we successfully retested that. So did home builders, by the way. Here's financials retesting the pre-great financial crisis highs. And then here's home builders. Obviously, the ETF companies, in their infinite wisdom, launching the home construction ETF at the peak. At the peak. And what happened last month? Home construction retested those levels. What were the culprits of that year, of that bear market? Homies and financials. Both successfully retested. I got to tell you, if we lose those lows, these summer lows, if they break, this market is in trouble, boy. In trouble. But if we're above those former resistance levels, how are you not buying these stocks? Broker dealers finding support at key levels. Regional banks back above the 2018 highs. Goldman Sachs putting in a bullish engulfing pattern last month. Morgan Stanley coming in hard. Bringing the heat, Morgan Stanley, with a 20-year base. How you doing? 20-year base. Above 90. How do you not own Morgan Stanley? Look at capital markets. We talk about financials as a group retesting the pre-great financial crisis highs. What about capital markets? Doing the exact same thing. You think it's a big deal? I do. So I guess you own Berkshire Hathaway. Berkshire Hathaway is the largest component of financials. Owns a lot of Apple. Apple's making new all-time highs on a relative basis. And you're getting industrial exposure as well. Just had a really nice ripper off the lows. So you own Berkshire? Berkshire's also been buying a lot of energy. Chevron, Occidental Petroleum, which we'll get into in a minute. Berkshire Hathaway, if we're above 284, I got no problem with this one long. By the way, if you're interested in the slides, email info@allstarcharts.com. Make sure to use the password breath expansion. Breath expansion. Info@allstarcharts.com, password breath expansion. All right. Notice how rates stopped going up? The academics, the efficient market monkeys, will tell you that that is just a coincidence, JC. It's just a coincidence that the 30-year yield stopped going up at the exact same level it stopped going up a few years back. Just coincidence, JC. That's what the efficient market monkeys will tell you. And then your parents are paying a fortune for these college tuition, or as parents, we are paying a fortune for these college tuition for these professors to have the audacity to tell our children that this is just a coincidence. Silly. So bonds bouncing off those 2018 lows, as you can see here on the TLT. Same thing with the IEF, bouncing off those 2018 lows. And then here's what's going on. It's a bond trade, right? So in black, you've got the NASDAQ versus the S&P 500. And in blue, you've got large cap growth versus value. The NASDAQ, you're not getting any financial exposure, no energy, no materials, right? No real estate. And then the S&P 500, you have a lot more cyclical exposure. You got the industrials, you got financials, of course, et cetera. In growth, what do you got? You got your tech, you got the stuff that's in the NASDAQ. In value, you've got the cyclicals and stuff, the stuff that's in the S&P. So the ratio of NASDAQ and S&Ps are going to look the same as growth versus value. So as bonds, and it looks like bonds, obviously. So because when interest rates are going up, value tends to outperform growth. When interest rates are going down, growth tends to outperform value. So as you can see here, the bounce in bonds, it's not a bad thing for growth, as you can see here. These growth stocks have gotten crushed. Here are the small caps. Here's the large caps, just absolutely crushed with bonds crashing. And then this is basically the poster child, right? This is the poster child for the whole thing, for this cycle. When we talk about 2007, 2008, what are the poster children of that cycle? Financials and homies, right? What was it this cycle? ARK, the SPACs, growth in general, right? Small cap growth, those were it. So if we're above 47, I'm going with the old scoop and score. Scoop and score is a pattern I made up, right? Because it's kind of like a scoop and then you score, right? For you football aficionados, when the fat lineman picks up the ball and rumbles and stumbles into the end zone, that's a scoop and score. We do that in the stock market as well. Or is it a bearish rising wedge? Right? Is this a continuation pattern within a bear market or scoop and score? I think it's scoop and score. I do. I think it's scoop and score. Look at consumer discretionaries versus consumer staples breaking out. Is this a heads up that ARK's going to do the same thing? I think it is. I think it is. How about Facebook? How about Facebook? I got one more Facebook chart I want to show. Here you go. Here's a zoomed in look. So Facebook, the low in 2012, high last year. Where did it stop going down? At exactly the 61.8% retracement of the entire move. Coincidence? The efficient market monkeys will tell you it is. I will not. And then here's a zoomed in look at that. Here's a zoomed in look at the Facebook. Or the meta, as the kids call it these days. I'm never going to get used to that. I still put FB on the charting software, and it keeps telling me that there's nothing there when it comes up. And I keep getting frustrated, and I still don't learn. How long do you think it's going to learn? It's going to take me to unlearn that habit of putting FB. Still haven't unlearned it. Look at that support. So here's the 61.8% retracement, all that former support. And then here's Facebook against those lows. We're above 158. I see no reason not to own this. You know what it reminds me of? Look at this. Look at me creating slide decks on the fly. Look at that. Reminds me of gold miners in early 2016, don't it? Look at that. So look at Facebook. 1, 2, 3, 4. 1, 2, 3, 4. Ripper. Is it going to be like that? And we're going to get a ripper? This would be a perfectly logical place for a ripper to occur. It would. Perfectly logical place for a ripper to occur. So if we're above that 158, I got no problem with it from the long side. Here we're looking at small cap stocks. This is our minor leaguers. These are stocks between $1 and $4 billion in market cap. Traditionally, small caps are between 300 million and 2 billion, but we make our own rules around here. 1 to 4 billion is what we're looking for small caps. Comfort Systems, interesting stock here. I would keep an eye on it. $3.8 billion. When we sort our small cap, our small cap scans, we sort by relative strength. So you're seeing this one making new all-time highs. How many stocks do you know that are making new all-time highs? Last week we got 40. So not many is the answer. Above 108, I like this one long for sure. And then let's finish up with some commodities. Seasonality says you buy commodities right here. You buy it right here, baby. That's what it says. You buy it right here. So here's what I'm wondering. Do this, build it, drop it in charts on the fly. You see that? So if this is where you buy commodities, and you look at the biggest commodity of them all, biggest weighting in the CRB, is this where you buy it? You're buying this dip in crude oil? I think if we're below 93, you can't. I think this needs to be an above 93 only trade. You want to buy this pullback in oil, got to be above 93. Otherwise, this is just completing a top, like so many other things. Because the way I see it traditionally, When commodities are outperforming, that doesn't just happen for a year or two. That tends to happen for a decade. And we're just entering year 3 of this. Seems like we're early. If you're looking for a pullback to take advantage of that, I like this pullback. Again, only if crude oil is above 93. And I would add one more thing to that. I would add the XLE. It's messy, right? Look at these highs from 2016, 2017, 2018 before the ultimate collapse. And we're struggling with that. So without XLE above 79.80, it's tough. So what's it going to take to be long energy? I need to see the XLE above 79 and crude oil holding above 93. There's some individual opportunities like Chevron came back, retested that breakout level from 2018, bounced off that level. Occidental Petroleum, Warren Buffett continues to buy with his warrants. He owns about 30% of this entire company, right? Occidental Petroleum. And then speaking of warrants, Oxy does trade the warrants is what it looks like. We're above 40, 41. I like the warrants long on the Oxy. Look at Canadian Natural. Or above those former highs. Look at the size of this base, above 55. I like that long. Makes a lot of sense. And then finally, gold. I mean, what a piece of hot garbage this thing has been. What a piece of hot garbage. That's what Edwards and McGee called stocks and downturns, hot garbage back in the 1940s. What happens if real rates collapse? Got a little taste of that. Right, so here we're looking at 10-year yields, real rates inverted. So as the black line is going up, those are real rates falling. So those are inflation adjusted by real, by the way. And gold historically loves fall in real rates. Loves it. Is that what it's going to take to get gold going? That's the question. Is that what it's going to take? Because I got to tell you, it's a mess. Stuck below these overhead supplies since 2011, gold. Down near the bottom of this range. Do you buy gold down here? That's the question. That is the question. Gold currently, gold down near 1770. Holding those levels so far. Gold miners making new 2-year lows. Got to get above 31 for me to take it seriously. Silver had its best week since August of 2020, but still below all that overhead supply. Right? That's how I see it. I'll leave you with 2 more charts. Bitcoin finding support last month at former resistance from the prior cycle's peak. Same thing with Ethereum. JC, what do you think of Bitcoin and Ethereum? If we are above the highs from the last cycle's peak, late 2017, early 2018. If we're above those levels, I'm in. If we're above those levels, I'm in. If we're not, I'm not. I think we have a lot of those opportunities in current markets. A lot of those opportunities. Ladies and gentlemen, if you are interested in the slides from this deck, email info@allstarcharts.com and use the password breathexpansion. I once again am your host, JC Parets, founder of allstarcharts.com. And to quote the great philosopher, Mr. Sean Carter, you could be anywhere in the world, but you're here with me. And I appreciate that. Thanks, guys.